Morning guys, Joel Frank here, market analyst for YouTrading, and this morning we're taking a quick look at the S&P 500. This major US stock index continues to be pretty well supported. Now it has seen a bit of a pullback this week from highs. On Monday, Monday just before the close, we managed to close at record highs above 4,480, but we pulled back about 1% from those levels. We're now around the 4,440 mark, but as you can see, this 21-day moving average here and this area, which used to be pretty strong resistance, but has more recently become support, that area was pounced on by the bulls, and they bought the dip. So now we're settling in ahead of some key US events. The major one this week being the release of the FOMC minutes from the July meeting. So that's going to be the next major driver for this stock index. But in my opinion, partly based on past experience, but partly based on fundamentals, and I'll explain, I think the S&P 500 is going to remain pretty well supported going forward, or at least it's going to remain a buy on dips. So first of all, past performance. Well, as you can see, going all the way back, I mean, let's zoom right the way out. Yeah, going all the way back to sort of December, every time the index has fallen below its 21 DMA or 50 DMA, it's been able to recover. And this has happened time and time again, and the bears have been proved wrong, and the bulls, or the dip buyers at least, have been proved right time and time again. Fundamentally speaking, I see no reason in the immediate future why this should change, because number one, and this helps stocks hit record highs at the start of this week, the earnings season for Q2, which is now wrapped up. We've had most of the earnings out from the major US companies, but it was a very strong earnings season in Q2. So that's made equity investors more comfortable with equities being at these higher valuations. Second, yes, the US economic data has started to show some early signs of weakness, mostly due to the damage that higher than expected inflation has done to the consumer, and also due to the resurgence of the coronavirus. But the US labor market continues to do very well. Okay, so it seems as though underlying economic strength in the US should be there. And anyway, even though the Fed is moving towards tapering, these FOMC minutes are likely to be quite hawkish, and there is a big risk that FOMC Chairman Powell at the end of the month at the Jackson Hole Central Bank event, there is a risk that he's going to announce or hint towards an imminent QE tapering announcement. Accommodative monetary policy in the US isn't going anywhere anytime soon. Markets seem pretty comfortable with the idea at the moment of rate hikes starting later in 2022 or in 2023. They seem to be seeing that as the appropriate Fed policy response to the US economic recovery. So as long as the pandemic situation in the US doesn't take a significant turn for the worse that significantly dents the US recovery, and as long as FOMC policy is still expected to be appropriately accommodative, I think these US stock markets are going to continue with this trajectory higher. There'll be an occasional knock like we've seen time and time again, like a 5 to 10% correction every couple of months. But I suspect this 50-day moving average is going to continue to be a really strong level of support. So guys, hope you enjoyed the video, and I will see you all in the next one.